Today's Wall Street Journal. We're breaking down the biggest business stories of the day, what happened, why it matters, and where the incentives really are. First article from Journal Trump to pick Warsh for Fed. Kevin Warsh is about to become chair of the Federal Reserve. That's not a financial decision. That's a political victory. And when the Federal Reserve becomes a political victory, monetary policy becomes a political tool. And when monetary policy becomes a political tool, the entire financial system becomes unstable. This is a story about institutional decay. This is a story about the corrosion of the one thing that keeps an economy from devolving into chaos: credible, independent monetary authority. Let me explain what's happening and why it matters more than anything else on Wall Street right now. Jerome Powell has been the chair of the Federal Reserve. For years, Jerome Powell was supposed to be independent from the president, independent from Congress, independent from the markets. His job was to manage inflation. His job was to manage employment. His job was to set interest rates based on economic data, not political pressure. But that independence is now gone, and it's being replaced by something far more dangerous: a Fed chair selected for his willingness to align with the president's priorities. Trump announced Thursday that he would name his pick for the next Fed chair. Then he met with Kevin Warsh at the White House. Then Trump moved up the announcement to Friday and said he'd picked Warsh. That acceleration, that Friday announcement after a Thursday statement, tells you everything. Trump was so comfortable with his choice that he couldn't wait to tell the market. Kevin Warsh is a former Federal Reserve governor. He's a critic of the Fed. He's made a career over the past few years of saying the Fed is doing everything wrong. He's called for what he explicitly calls regime change at the Federal Reserve. That's not a policy disagreement. That's a call to tear down the institution and rebuild it, according to his philosophy. And here's the key: Warsh's philosophy aligns perfectly with Trump's priorities. Trump wants lower interest rates. Trump wants a weaker dollar. Trump wants faster growth and reshored manufacturing. And Warsh has already signaled complete alignment with all of that. Now let me trace how this happened. How did we get from the Fed is an independent institution to the Fed chair is selected for his political alignment? It starts with institutional independence. The Federal Reserve was created after the financial crisis of the Great Depression. The lesson learned was this: if the president controls the central bank, the president will print money to win elections. If the president prints money to win elections, inflation spirals out of control. So the Fed was designed to be independent. Congress sets the law. The president nominates the chair, but once nominated and confirmed, the Fed chair is supposed to make monetary policy decisions based on economic data, not political pressure. That was the design. That was the principle. That was the credibility that made the dollar the world's reserve currency. That made American Treasury bonds the safest asset in the world. That made the entire global financial system depend on U.S. monetary stability. That principle is now gone. It started 3 years ago when Trump began publicly criticizing Jerome Powell. Trump said Powell was raising interest rates too fast. Trump said the Fed was the biggest threat to the economy. Trump said Powell should cut rates faster. Trump said the Fed was his problem. And Powell, to his credit, tried to maintain independence. He didn't cut rates when Trump demanded. He held rates steady, but the pressure was constant. Public pressure, private pressure, political pressure from Congress. Trump even appointed 2 Fed governors specifically to vote for lower rates. Then came the Justice Department probe. The probe is ostensibly about Powell's testimony to Congress regarding building renovations at the Fed. But Powell himself said it clearly. This is a pretext for Trump to get the lower interest rates he wants. Think about what that means. The Justice Department is investigating the Fed chair. For what? For testimony about building renovations. That's not a serious criminal investigation. That's political intimidation. That's the president using the justice apparatus to pressure the Fed chair. And it's working. The pressure is visible. Powell capitulated. He cut rates. Then he cut again. 3 consecutive cuts last year. Then he paused. And immediately Trump criticized him again. The criticism is just pressure, but it works. Now Trump is replacing Powell with someone who's already aligned with his priorities. Someone who's already called for regime change at the Fed. Someone who explicitly said the Fed should cut rates faster. Let me be clear about what Warsh represents. He used to believe in free trade. Now he supports Trump's tariffs. He used to believe in market-driven exchange rates. Now he aligns with Trump's weak dollar policy. He's not a principled person who happens to agree with Trump. He's a political operator who shapes his views to align with whoever holds power. In April of 2025, Warsh gave a speech at the International Monetary Fund. He said, and I'm quoting directly, "The Fed's current wounds are largely self-inflicted." That's not a statement of fact. That's an opinion. An opinion shaped by the fact that he knew Trump wanted faster rate cuts. He was auditioning for the Fed chair job, and he was telling Trump what Trump wanted to hear. On television, he called for regime change at the Fed. Regime change. That's language you use for governments you want to overthrow, not institutions you want to improve, not central banks you want to reform. Regime change. That's revolutionary language. That's political language. And now he's going to be Fed chair. Let me explain what this means for capital allocation. The Federal Reserve controls interest rates. Interest rates are the foundation of all capital allocation. They're the discount rate used to value every business. They're the cost of borrowing for every company. They're the return benchmark for every investor. They're the price of money itself. When interest rates are set by an independent central bank based on economic data, markets have confidence. Investors can price risk appropriately. Companies can make long-term investment decisions. Lenders can charge appropriate interest rates. Everything is built on the assumption that the Fed is making decisions to manage inflation and employment, not to boost the stock market or help the president get reelected. But when interest rates are set by a Fed chair who's aligned with the president, everything becomes suspect. Is the Fed cutting rates because the economy needs it? Or because the president needs it for the election? Is the Fed holding rates steady because inflation is under control? Or because the president doesn't want higher rates? The market is already questioning this. Look at the dollar. The dollar should be strong. The U.S. economy has delivered strong growth. The stock market hit record highs. Under normal conditions, that drives dollar strength. But the dollar is weak. Why? Because the market is losing confidence in Fed independence. Because the market thinks the Fed will prioritize lower rates over dollar stability. Look at gold. Gold surged to record highs. Why? Because gold is a hedge against currency debasement. Investors are hedging against a weak dollar because they think the Fed will debase it by cutting rates for political reasons. Look at mortgage rates. Mortgage rates should be falling if the Fed is going to cut rates. But mortgage rates are stuck. Why? Because the market doesn't believe the Fed's rate cuts will be credible. Because the market thinks rates could reverse if the political winds shift. This is the hidden cost of politicizing the Fed. It's not immediately visible. It's not in today's stock prices. It's in the erosion of confidence. It's in the dollar's weakness. It's in gold's strength. It's in the market's confusion about what interest rates actually mean. Let me talk about the Senate confirmation. Warsh still needs Senate approval. And there's an obstacle. Senator Thom Tillis from North Carolina sits on the banking committee. He has said explicitly that he will block any Trump Fed nominee until the Justice Department investigation of Powell is resolved. Now, Tillis is a Republican. He's from Trump's party. And yet he's saying, we're not confirming new Fed chairs while you're investigating the old one. That's not a partisan statement. That's a statement about institutional preservation. That's Tillis saying, if we let this happen, the Fed is no longer an independent institution. Tillis understands the stakes. He understands that if the Fed becomes a political tool, it will be a tool for whoever's in power. And once that precedent is set, it never goes back. The next president will do the same thing. The president after that will do the same thing. And within a generation, the Fed becomes just another political agency. But I'm skeptical that Tillis can hold the line. The pressure will be immense. Trump will call him. Trump will threaten to primary him. Trump will make it costly politically to block the nomination. And in the end, most Republicans will fold. The Fed will be politicized. Now, let me extract 3 lessons from this institutional decay. First, independence is fragile. It only exists if people defend it. The Fed was designed to be independent, but it's not automatically independent. It only stays independent if the chair resists political pressure, and if Congress and the president respect that independence. Once that respect is gone, independence vanishes. Warsh doesn't believe in Fed independence. Trump doesn't believe in Fed independence. Most of Congress doesn't believe in Fed independence anymore. So independence is gone. The lesson is, institutions depend on the people inside them choosing to uphold their principles. Once the people stop defending the principles, the institution collapses. Second, Alignment of incentives and principles is not the same thing. It feels good when the Fed chair aligns with the president on economic policy. It feels good when they have the same priorities. But that's the danger. The Fed chair should not have the same priorities as the president. The Fed chair should have different priorities. The Fed chair should care about inflation and employment. The president should care about growth and re-election. When those interests conflict, and they will, the Fed chair should side with the Fed's mandate, not the president's mandate. Warsh has already shown he'll side with the president. That's not alignment. That's institutional capture. Third, monetary credibility cannot be recovered once lost. Once the market believes the Fed is political, that belief is sticky. It doesn't go away when a new president takes office. It doesn't go away when the Fed makes one independent decision. Credibility takes decades to build. It takes one generation of politicization to destroy. Japan dealt with this in the 90s. The Japanese central bank was seen as too subservient to the government. For 30 years, the market didn't believe in Japanese monetary policy. That lack of belief became a self-fulfilling prophecy. Rates stayed low. Growth stayed weak. They spent 30 years recovering credibility. We're about to start down that path. Here's my closing conviction. The Federal Reserve is no longer an independent institution. Kevin Warsh will be confirmed as chair. He will cut rates faster than economic conditions warrant. He will align with Trump's priorities. He will talk about regime change at the Fed, but he will have already captured the institution. The consequences will be visible over the next 5 to 10 years. The dollar will weaken. Inflation will be harder to control. Interest rates will become less predictable. Capital allocation will become more difficult. Investors will demand a risk premium for holding dollars and treasury bonds. Borrowing costs will rise for the government and corporations. The financial system will become less stable. And it will be because we allowed an independent institution to become a political tool. Because we allowed a president to pressure a Fed chair until he capitulated. Because we allowed the principle of institutional independence to erode without defending it. The most dangerous moment for an institution is not when it faces an external threat. It's when the people inside it stop believing in it. Warsh doesn't believe in Fed independence. Trump doesn't believe in Fed independence. And once the people inside the institution stop believing in the institution is finished. Here's the sentence you'll remember. The death of institutional independence is not sudden, it's gradual, and by the time everyone sees it, it's already too late to save. Moving to next title, Spy Chief Gabbard has been hunting for 2020 election fraud for months. Tulsi Gabbard, the Director of National Intelligence, has spent months investigating the 2020 election that Donald Trump lost. She flew to Georgia and participated in an FBI search of an election office. She's studied voting machines, she's analyzed swing state data, she's pursued theories that Trump has promoted, and she's done all of this while holding a position that's supposed to focus on foreign threats to national security. This is not a story about election fraud. This is a story about institutional capture. This is what happens when the most powerful person in the country uses the apparatus of government to investigate a personal obsession. And it happens slowly, almost invisibly, until one day you look up and the institution is entirely corrupted. Let me explain what's happening and why it matters more than you think. The Director of National Intelligence is supposed to do one thing: ensure the president has the best intelligence available to make national security decisions. That's the job. Not to investigate past elections, not to pursue theories about fraud, not to satisfy the president's personal grievances. The job is to protect the nation by providing accurate, unbiased intelligence about foreign threats. Tulsi Gabbard is not doing that job. She's doing something else entirely. She's leading the administration's effort to re-examine the 2020 election results. She's looking for potential crimes. She's briefing Trump and his chief of staff regularly about her findings. She flew to Georgia and participated in the execution of a search warrant at Fulton County's election office. Let me be clear about what this means. The intelligence agencies under Gabbard's oversight are supposed to focus on activities abroad. They're generally prohibited from engaging in clandestine operations within U.S. borders. That's on purpose. That's by design. Intelligence agencies are supposed to spy on foreign governments, not on American elections. But Gabbard is using the intelligence apparatus to investigate a domestic election. Specifically, an election that happened 6 years ago. An election that multiple audits have confirmed. An election that every Republican election official certified. An election that every court case examining fraud claims has rejected. Yet here's the DNI investigating it anyway. Trump has been fixated on the 2020 election since losing. He raises it constantly, publicly, with friends, with aides. It's an obsession. And now his administration is dedicating resources and personnel to investigating it. The Wall Street Journal reports that this effort has only recently begun to come into public view. But it's been happening for months. Months of investigation, months of resources, months of the intelligence community being redirected from its actual mission, protecting national security, to pursuing this obsession. Gabbard has studied information about voting machines. She's analyzed data from swing states. She's pursued theories that Trump has promoted. She's been involved in a separate effort to promote allegations that President Obama manufactured a false conspiracy about Russian interference in the 2016 election to undermine Trump's first presidency. Think about what this means. The 2016 election happened a decade ago. The 2020 election happened 6 years ago. But the DNI is investigating them. The DNI is supposed to be focused on current threats: China, Russia, Iran, cyber attacks, foreign interference in elections. Instead, the DNI is investigating past U.S. elections. On Wednesday, FBI agents searched Fulton County's election office in Georgia. Gabbard participated. The search warrant authorized agents to look for physical ballots, voter rolls, ballot images, and tabulator tapes from every voting machine in the county. They're looking for evidence of fraud. But here's what's important. Gabbard has also been sidelined from some normal DNI deliberations. The Venezuela operation earlier in the month, she wasn't involved. That's the kind of thing a DNI should be focused on: real national security threats. But instead, Gabbard is in Georgia looking at election records from 6 years ago. Now let me talk about what the actual investigators found. Ken Block is a consultant who studied fraud claims on behalf of the 2020 Trump campaign. His job was to find fraud. He had every incentive to find fraud. Trump wanted him to find fraud. The campaign wanted him to find fraud. And he said, "I was never able to substantiate any claim that would overrule the results." Think about that. A Trump campaign consultant spent months looking for evidence of fraud that would overturn the election, and found nothing that would change the outcome. Block said something else. He said, "That election is 6 years in the past. There's no undoing it." I can't imagine there aren't more important things to look at. That's the voice of someone who understands reality. That's someone who's exhausted by the obsession. That's someone saying, "We've looked. We didn't find anything. Can we move on?" But they're not moving on. The DNI is investigating. The Justice Department is investigating. Gabbard is pursuing theories. And there's still no evidence. Cybersecurity specialists, elections experts, many former top security officials who worked for Trump during his first term, all have maintained for years that there was no evidence of widespread tampering or fraud in the 2020 contest. Not fringe people, not Democrats, serious people, Trump's own people from his first administration. All say there was no fraud, but the investigation continues. Here's where the institutional capture becomes clear. Gabbard has been kept in Trump's good stead with White House officials because of her focus on the election investigation. Trump's press secretary said Gabbard is playing a key lead role in ensuring elections can never be rigged. But that's not the DNI's job. That's election security's job. That's the election official's job. The DNI's job is to spy on foreign governments. By making the election investigation the centerpiece of her job, Gabbard has aligned her incentives with Trump's political obsession. Her loyalty to Trump is demonstrated through her willingness to pursue an investigation that has no credible basis. Her position in the administration depends on continuing to pursue that investigation. This is institutional capture in real time. The DNI position has been reduced from a national security role to a political loyalty position. Now let me do the capital allocation autopsy. What was the expected purpose of the DNI position? Provide the president with foreign intelligence necessary for national security decisions. That's the capital allocation. Resources spent on monitoring foreign threats. Personnel focused on foreign policy. Technology and systems designed to collect foreign intelligence. What's actually happening? Resources are being diverted to investigate past U.S. elections. Personnel are being redirected from foreign threats to domestic politics. The institutional purpose has been corrupted. The opportunity cost is enormous. While Gabbard is investigating 2020, actual foreign intelligence threats are not being monitored as carefully. That's not hypothetical. That's the necessary trade-off of diverting resources from one mission to another. The hidden trade-off is credibility. The intelligence community's credibility depends on being seen as apolitical, on being focused on facts, not politics, on being willing to tell the president things the president doesn't want to hear. But when the DNI is pursuing the president's political obsession, the intelligence community loses credibility. Career intelligence officers know that their leadership is compromised. That changes how they operate. That changes what they're willing to report. Senator Mark Warner, the top Democrat on the Intelligence Committee, said this clearly. He said, "Either Gabbard believes there was a foreign intelligence nexus to the 2020 election, in which case she's violating her obligation to brief Congress, or she's demonstrating her utter lack of fitness for the office." Warner's right. The constitutional role of the DNI is to keep Congress informed of national security concerns. If Gabbard has found evidence of foreign interference in the 2020 election, she's legally obligated to brief Congress. She hasn't, which means she hasn't found evidence, which means she's pursuing an investigation she knows has no basis. That's institutional corruption. That's using power for a personal goal instead of an institutional purpose. Now let me extract 3 lessons from Gabbard's capture of the DNI position. First, institutional purpose erodes when leadership is selected for political loyalty instead of competence. Gabbard wasn't selected as DNI because she was the best person to protect national security. She was selected because she's loyal to Trump and because she's willing to pursue Trump's obsessions. Once an institution starts selecting leaders based on loyalty instead of competence, the institution's core purpose begins to degrade. The intelligence community is now led by someone whose priority is not national security, but presidential satisfaction. That's institutional rot. Second, when incentives are misaligned between the institution and the leader, the institution loses. Gabbard's incentive is to maintain Trump's favor by pursuing the election investigation. The DNI's incentive should be to provide the best foreign intelligence possible. These are in direct conflict. And because Gabbard has power, she's choosing her personal incentive over the institutional one. The institution doesn't have a choice. It has to follow her. And once an institution starts following a leader who's pursuing misaligned incentives, the institution becomes corrupted. Third, political obsession is incompatible with institutional purpose. The DNI position requires dispassionate analysis of foreign threats. It requires following evidence wherever it leads. It requires being willing to tell the president things the president doesn't want to hear. But Gabbard is pursuing an obsession. She's not following evidence. She's pursuing theories the president has promoted, and that makes her incompatible with the role. The institution would be better served by a leader who cares about national security than by a leader who cares about satisfying the president's personal grievances. Here's my closing conviction. Tulsi Gabbard has corrupted the Director of National Intelligence position. She's using one of the most powerful intelligence positions in the country to pursue a political obsession. She's investigating an election that happened 6 years ago, that every investigation has found no evidence of fraud in, that every Trump campaign operative who looked for fraud found nothing. But she continues because Trump wants her to continue. And continuing keeps her in Trump's favor. And Trump's favor is what matters now, not national security. This is institutional capture. This is what happens when the president's personal loyalty becomes more important than institutional purpose. This is what happens when leadership is selected for alignment with a political obsession rather than competence in the actual job. The intelligence community will recover from this, but not until new leadership takes over. Not until the DNI position is restored to someone focused on national security rather than personal loyalty. And that recovery will take years, because credibility, once lost, is the slowest thing in the world to rebuild. Here's the sentence you'll remember. The most dangerous moment in an institution is not when it faces external threats, but when its leadership turns it into a tool for a personal obsession. Moving to next title, GameStop CEO eyes a major acquisition. Ryan Cohen is worth billions. He built Chewy into a $3 billion company and sold it at the peak. Then he bought control of GameStop, a dying video game retailer. And now he's telling the world that he's going to turn GameStop into a $100 billion company. Not by saving the game business, by using GameStop as a shell company to buy something else entirely. This is not a story about video games. This is a story about capital allocation. This is a story about a founder who understands that sometimes the best use of a company is not to operate it, but to use it as a vehicle for deploying capital elsewhere. This is the Berkshire Hathaway playbook, and it's one of the most underrated strategies in business. Let me explain what Cohen is doing, and why the market should be paying attention. Ryan Cohen founded Chewy in 2011. He took an online pets retailer and built it into a genuine business. Chewy shipped pet food. Real customers, real revenue, real operations. He grew the company from nothing and sold it to PetSmart for over $3 billion. That was a win. That was a founder building something real and cashing out at the peak. Then Cohen became an activist investor. He bought stakes in broken companies. Nordstrom, Bed Bath & Beyond. He pushed for change. He agitated for better operations. He modeled his strategy after Warren Buffett and Carl Icahn, two of the greatest capital allocators in history. Then Cohen bought control of GameStop, a company that's dying. A company whose core business, retail video games, is being destroyed by digital downloads. A company whose revenue is declining. A company whose future is increasingly bleak. But Cohen didn't buy GameStop to save it. He bought GameStop to use it. Here's what happened. GameStop got caught up in the meme stock phenomenon. Retail investors piled in. The stock soared. For a moment, GameStop was worth billions. Cohen saw an opportunity. He used that inflated valuation to raise capital. He raised cash by exploiting the meme stock phenomenon. Investors were buying the stock for the story, for the nostalgia, for the community. Cohen was buying the stock because it gave him capital to deploy. This is brilliant. This is using market psychology to your advantage. The meme stock investors wanted GameStop to become something it could never be, a dominant video game retailer competing with digital platforms. Cohen knew that was impossible, but he didn't care. He was using their capital. Now Cohen has control of a company with cash, a company with a stock that trades, a company with a shell that he can use for acquisitions. And he's told the world he's going to use that shell to buy something real. He wants to acquire a publicly traded company in the consumer or retail industry, something with actual business fundamentals, something with actual cash flow, something that can grow. And he wants to pay up to $10 billion or more for it. When Cohen acquires that company, what happens? GameStop becomes a holding company. The acquired company becomes the operating engine. GameStop's stock becomes the parent company. The parent company owns the acquisition. Value gets created through operational improvement, market consolidation, or just plain arbitrage. This is the Berkshire Hathaway playbook. Warren Buffett didn't build Berkshire by improving textiles. He bought Berkshire Hathaway as a shell and used it to acquire insurance companies, utilities, and manufacturers. He deployed capital at the holding company level. Operationally, he acquired quality businesses run by great managers. Financially, he created value through disciplined capital allocation. That's what Cohen is trying to do. He's trying to be Buffett. He's trying to find an undervalued consumer or retail company and acquire it. Use GameStop's cash and stock as currency. Combine the operations with GameStop. Create a real business. The question is, can he execute? Michael Burry thinks he can. Burry, the doctor turned hedge fund manager famous for betting against subprime mortgages in '08, has been watching Cohen. And Burry is bullish. He closed his hedge fund and started a Substack newsletter. And in that newsletter, he wrote about GameStop. Burry said Cohen has a crappy business and is milking it best he can while taking advantage of the meme stock phenomenon to raise cash and wait for an opportunity to make a big buy of a real growing cash cow business. That's not criticism, that's accurate description. Burry understands what Cohen is doing. Burry is saying, yes, the core business is crappy. Yes, you're using the meme stock phenomenon. Yes, you're waiting, but that's the strategy. Burry then said, if Cohen spends $10 billion or more to acquire a quality business, there's significant upside. Burry bought more GameStop shares. Burry is betting on the acquisition. Now let me talk about Cohen's compensation structure. This is where the capital allocation incentives become crystal clear. The board adjusted Cohen's compensation package in early 2006. The structure is this. Cohen's upside is unlimited if he hits certain targets. Part of the award vests when GameStop's market value reaches $20 billion and EBITDA reaches $2 billion. The full award vests when GameStop's market value reaches $100 billion and EBITDA reaches $10 billion. How much is this award worth? as much as $35 billion. $35 billion in potential stock value. This is moonshot compensation. This is Elon Musk territory. In November, Tesla shareholders approved a pay package for Musk that could be worth as much as $1 trillion if certain milestones are reached. It's the same structure. It's the same principle. The CEO's compensation is entirely tied to creating value, not to salary, not to bonus, to stock price and profitability metrics. What does this mean? It means Cohen has zero incentive to do anything but swing for the fences. He doesn't make money by slowly improving GameStop's core business. He doesn't make money by optimizing operations. He makes money by creating a transformative event, an acquisition, a major capital deployment, a business combination that creates value. The incentive is perfectly aligned. Cohen's compensation is only paid if he successfully executes a major value creation event. If he does nothing, the stock declines and he makes nothing. If he swings and hits, the stock soars and he makes $35 billion. Now let me explain Cohen's explicit risk assessment. He said something remarkable. He said, "It's ultimately either going to be genius or totally, totally foolish." That's not hedge speak. That's not corporate optimism. That's a man acknowledging that there is no middle ground. Either this works and creates extraordinary value, or it fails completely and the stock goes to zero. There's no base case. There's no moderate success. It's binary. Why is it binary? Because GameStop's core business is terminal. The video game retail business is dying. Digital downloads are inevitable. Physical retail is structural decline. No amount of operational improvement saves GameStop as a video game retailer. So if Cohen doesn't find an acquisition, if he doesn't execute that capital deployment, GameStop eventually goes to zero. The meme stock premium evaporates. The cash is drawn down, the shell collapses. But if Cohen finds the right acquisition, a real business with real fundamentals, he can create a holding company that grows. He can use GameStop's shell and cash to build something real, and the value creation is potentially enormous. This is why Cohen said it's genius or totally foolish, because the outcome is binary. There's no graceful decline, there's no boring optimization. Either he makes the acquisition and wins big, or he doesn't and loses everything. Now let me do the capital allocation autopsy. What was expected? When Cohen took control of GameStop, the expectation was he'll try to save the video game business. He'll reduce stores, he'll optimize operations, he'll cut costs. Maybe the company survives. What's actually happening? Cohen is ignoring the core business entirely. He's using the company as a capital deployment vehicle. He's going to buy something else. The opportunity cost? If Cohen owns GameStop but does nothing, if he just waits, the stock slowly declines. Every quarter, GameStop loses money. Every quarter, the meme stock premium erodes. Every quarter, cash is burned. The company eventually becomes worthless. But if Cohen owns GameStop and uses it to deploy capital into a real acquisition, GameStop becomes a holding company. The acquisition provides earnings power. The holding company stock becomes valuable. Value is created through capital allocation, not operations. The hidden trade-off? The acquisition has to be good. It has to be a real business with real growth. If Cohen overpays, if he acquires something broken, if he executes poorly, GameStop becomes a holding company that owns a bad business. That's worse than the original GameStop. So Cohen has to be a great allocator. He has to find a business worth more than he pays for it. He has to execute the acquisition. He has to improve operations. He has to create value. That's not guaranteed. That's incredibly hard. But that's what the incentive structure demands. That's what the $35 billion upside is paying for. That's what Cohen is betting his career on. Now let me extract 3 lessons from Cohen's capital allocation strategy. First, a broken company with cash is more valuable than a broken company without cash. GameStop is dying as a retailer, but GameStop with cash and a public stock is a vehicle for deploying capital. Cohen is not trying to save GameStop. He's using GameStop as a tool to buy something else. This is a fundamental insight in capital allocation. Sometimes the best use of a company is not to operate it better, but to use it as a platform for deploying capital elsewhere. A shell company with cash is worth more than the best managed zombie. Second, incentive alignment at the moonshot level creates real discipline. Cohen's compensation is unlimited upside only if he hits transformative targets. This is not a CEO bonus tied to incremental improvements. This is a founder compensation tied to creating value at scale. When incentives are aligned that starkly, either zero or billions, the leader focuses. Cohen can't afford to tinker. He has to swing. And that discipline is actually valuable. It prevents the slow decline. It forces transformation or exit. Third, binary outcomes are sometimes the only honest outcome. Cohen said it, genius or totally foolish. There is no middle ground. This is honest. Most CEOs talk about incremental improvement and sustainable growth. Cohen is saying, the core business is dying. I'm making a bet on capital deployment. Either it works or it doesn't. That honesty is refreshing. And it's the only rational position when the core business is terminal. Here's my closing conviction. Ryan Cohen is making the right capital allocation decision. He inherited, or took control of, a dying company. Rather than trying to save it, he's using it as a vehicle to deploy capital at scale. He's raising capital through the meme stock phenomenon. He's compensating himself only if he succeeds in creating value. He's modeling his strategy after the greatest capital allocators in history. Whether he succeeds is an open question. Finding the right acquisition target is hard. Executing integration is harder. Creating value through operational improvement is hardest. But the strategy is sound. The incentives are aligned. The outcome is binary. And Cohen understands all of that. The market doesn't yet understand what Cohen is doing. Most investors still think he's trying to save GameStop. They don't realize he's using GameStop as a shell, but over the next few years, it will become clear. Either Cohen makes a transformative acquisition and creates value, or he doesn't, and the stock goes to zero. That's the bet. That's the strategy. That's the binary outcome. Here's the sentence you'll remember. The greatest capital allocators sometimes inherit broken companies not to fix them, but to use them as vehicles to buy something real. Moving to next title, Carlyle to buy Lukoil assets. Carlyle just won a provisional deal to buy Lukoil's international assets. Lukoil is Russia's second biggest oil company, and it's sanctioned, blacklisted, turned into a pariah by U.S. government policy. And Carlyle is about to own its gas stations, refineries, and oil fields across Europe, the Middle East, and Central Asia. This is not a story about energy. This is a story about capital allocation under constraint. This is a story about how great private equity firms don't just look for undervalued assets. They look for assets that are undervalued because of temporary constraints, geopolitical constraints, regulatory constraints, political constraints. And they have the expertise and connections to navigate those constraints, while competitors don't. Let me explain what Carlyle is doing, and why this deal reveals how capital allocation really works. Lukoil is one of Russia's largest energy companies. Before sanctions, it was a global operator. Gas stations around the world, refineries in Europe, oil fields in the Middle East and Central Asia. It was a diversified energy company with real assets and real cash flow. Then Russia invaded Ukraine. The United States sanctioned Lukoil. The company became a pariah. International markets froze it out. Customers disappeared. Partners fled. Lukoil went from a global energy company to an isolated, sanctioned entity with assets it couldn't operate or sell. The assets didn't change. The oil fields didn't disappear. The refineries still worked. The gas stations were still there. But the market value collapsed because the company couldn't access international markets, couldn't trade, couldn't raise capital, couldn't deploy assets across borders. That's constraint-induced value destruction. The assets are the same. The constraint is the sanction. The value plummeted. Enter Carlyle. Carlyle is a Washington-based private equity firm. It manages $474 billion. It has $20 billion allocated specifically to energy, renewables, and infrastructure. And Carlyle looked at Lukoil's international assets and saw an opportunity. Here's what Carlyle saw. Lukoil valued these assets at $22 billion in company filings. That's the valuation in normal market conditions. But because of sanctions, the assets are essentially unmatchable. No one can buy them, no one can operate them. No one wants them. The market is frozen. But Carlyle can buy them. Carlyle has relationships with the Treasury Department. Carlyle has lawyers who understand sanctions compliance. Carlyle can structure the deal to satisfy U.S. regulatory requirements. And Carlyle is betting that sanctions are temporary. That at some point, the political situation changes. That at some point, Lukoil can resume normal operations, or Carlyle can operate the assets under new management. So Carlyle struck a provisional deal. Not final. Still negotiating price. Still need Treasury approval. Still in competition with other bidders. But Carlyle has the inside track. Carlyle has the political access. Carlyle is going to own these assets. Now let me explain why this deal matters. It's not about the price. We don't even know the price yet. It's about capital allocation philosophy. It's about how different firms think about risk and opportunity. Blackstone is backing away from energy. The industry is falling out of favor. Environmental concerns, energy transition. Oil looks like a dying business. So Blackstone is divesting. Blackstone is moving capital elsewhere. Carlyle is doing the opposite. Carlyle is deepening its energy exposure. Carlyle is investing in European refiners, African drillers, Latin American operators, and now Carlyle is buying a sanctioned Russian energy company's international assets. This is a fundamental divergence in capital allocation philosophy. Blackstone sees energy as a sector in decline. Carlyle sees energy as a sector where disciplined allocators can still find value. Which is right? I don't know. But here's what I know. Carlyle is thinking differently. Carlyle is willing to navigate complexity that others avoid. Carlyle is willing to take geopolitical risk that others reject. And if Carlyle is right, the returns could be extraordinary. Now let me talk about the deal structure. Carlyle struck a provisional agreement to buy Lukoil's international assets, but the deal has massive constraints. First, it requires U.S. Treasury Department approval. The Treasury is the gatekeeper. Treasury sanctioned Lukoil. Treasury will decide if Carlyle can buy Lukoil's assets. Carlyle can't close the deal without permission. Second, the U.S. has explicitly said the buyer cannot release funds to Lukoil until sanctions are lifted. This is crucial. Carlyle can buy the assets, but Carlyle can't pay Lukoil until sanctions end. That means the money sits in escrow, potentially for years. That means Carlyle owns the assets, but Lukoil doesn't get paid until geopolitical situation changes. Third, Carlyle faces competition. Multiple bidders sought permission to buy Lukoil's assets. Todd Boehly, the private equity mogul, bid. Gunvor, a Swiss trading firm, bid. The Trump administration explicitly rejected Gunvor's bid, called Gunvor a puppet for the Kremlin. Gunvor denied the characterization as fundamentally misinformed and false. But the point is made. The Trump administration prefers Carlyle to Gunvor. Carlyle is U.S.-based, located a few blocks from the White House, has access to Trump administration officials. Gunvor is Swiss. International, outside the Trump administration's comfort zone. This is how capital allocation actually works. It's not just about finding undervalued assets. It's about having the political relationships to access those assets. Carlyle's Washington location is a competitive advantage. That sounds cynical, but it's true. Now let me do the capital allocation autopsy. What was expected? Lukoil needed to sell its international assets because it was sanctioned. The expectation was, which PE firm can navigate the regulatory complexity and buy these assets at a discount to intrinsic value? What's actually happening? Carlyle is buying at a discount. But the discount is uncertain because asset value is hard to assess when the company is sanctioned. Carlyle is paying some price, but the price depends on assumptions about when sanctions will be lifted. Carlyle is betting on geopolitical change. That's not typical private equity. That's geopolitical arbitrage. The opportunity cost? If Carlyle doesn't buy these assets, Lukoil might sell to Gunvor or Boehly or someone else. Carlyle's first-mover advantage with Treasury is valuable. But it also locks Carlyle into a deal with regulatory risk. The hidden trade-off? The asset value depends entirely on sanctions being lifted or changing. If sanctions remain for a decade, Carlyle owns assets it can't fully operate. If sanctions are lifted in 2 years, Carlyle owns assets worth far more than it paid. The entire economics of the deal depend on a geopolitical bet. That's not business risk. That's political risk. Now let me extract 3 lessons from this Carlyle-Lukoil deal. First, regulatory constraints create opportunities for allocators who can navigate them. Most firms back away from sanctioned assets. Sanctioned companies are radioactive. But Carlyle sees an opportunity. Carlyle has Treasury relationships. Carlyle understands sanctions law. Carlyle can navigate the complexity, and that navigational ability is worth money. It's worth a competitive advantage over Gunvor. It's worth the opportunity to buy assets at a discount. Great allocators don't just look for undervalued assets, they look for assets that are undervalued because of constraints that other allocators can't navigate. Second, political access is part of capital allocation. This is uncomfortable to say, but it's true. Carlyle's Washington location mattered. Carlyle's relationship with Trump administration mattered. The Treasury rejection of Gunvor was based on political preference. If you want to be a great capital allocator, you need not just financial expertise. You need political relationships. You need access. You need to be able to influence regulatory decisions. That's not fair, but it's real. Third, geopolitical bets are the ultimate long-term capital allocation wager. Carlyle is betting that sanctions will change. Maybe in 2 years, maybe in 5 years, maybe in 10 years. The asset value depends on that bet. If sanctions are permanent, the deal is a disaster. If sanctions are temporary, the deal is brilliant. Carlyle is making a multi-year geopolitical bet. That requires conviction. That requires patience. That requires willingness to lock capital into an uncertain outcome for years. Here's my closing conviction. Carlyle is making a brilliant capital allocation move. The firm is buying assets that others have abandoned. The firm is navigating regulatory complexity that others avoid. The firm is betting on geopolitical change that others reject. Whether the bet pays off depends on geopolitics. If sanctions are lifted or relaxed, Carlyle owns assets worth far more than it paid. If sanctions remain, Carlyle owns assets it can't fully use. But here's what matters. Carlyle is thinking differently than Blackstone. Carlyle is willing to take risk that others won't. Carlyle is willing to navigate complexity that others can't. And that's how great allocators find the best opportunities. The market hasn't figured this out yet. The media is focused on the political intrigue, the regulatory complexity, the geopolitical tension. But the real insight is simpler. Carlyle found undervalued assets, assets that the market rejected because of temporary constraints. And Carlyle is confident enough in its ability to navigate those constraints that it's willing to bet billions on the geopolitical outcome. That's capital allocation at its finest. Here's the sentence you'll remember. The best capital allocators don't just find undervalued assets, they find assets that are undervalued because of constraints that other investors can't navigate. Moving to next title, Apple supplier ST Microelectronics posts rise in sales. Apple just reported record quarterly profits, $42.1 billion, the highest net income in the company's history. Revenue up, earnings up, iPhone sales up 23%. The demand was, according to Apple's finance chief, simply staggering. And yet, this is a story about constraints. This is a story about what happens when the most powerful company in tech discovers that it no longer has unlimited leverage over its suppliers. This is the moment when Apple's pricing power meets real limits, and Apple is responding the only way it can, by managing mix, managing costs, and trying to hold margin while the ground shifts beneath it. This is not a celebration of Apple's success. This is a diagnosis of Apple's inflection point. Tim Cook is the architect of this moment. Cook has run Apple since Steve Jobs died. Cook has overseen more than a decade of relentless margin expansion. iPhone prices have risen consistently. iPhone profit per unit has expanded consistently. Apple's gross margins have expanded consistently. The playbook was simple: build devices people want, raise prices, expand margins, repeat. That playbook worked for years. It worked because Apple had a product people couldn't live without. It worked because competitors couldn't match Apple's design and ecosystem. It worked because Apple had leverage over suppliers. Apple was the biggest buyer. Apple could demand favorable pricing. Apple could demand first access to components. Apple could demand that suppliers expand capacity. Now, something has changed. And that change is structural. It's not temporary. It's not cyclical. It's structural. Artificial intelligence has completely reordered the priority of chip capacity. AI data centers need advanced chips. Advanced chips for memory. Advanced chips for processing. Advanced chips for everything. And the companies building AI, Microsoft, Google, Meta, are willing to pay whatever it takes to get those chips. This has shifted supplier priorities entirely. Memory makers like SK Hynix and Samsung are now focused on AI data centers. Foundries like Taiwan Semiconductor are focused on AI chips. The suppliers that once viewed Apple as the biggest customer with the most leverage now view Apple as a customer competing for capacity against companies willing to pay unlimited prices for chips. This fundamentally changes Apple's position. Apple can still buy chips. Apple still has enormous purchasing power, but Apple no longer has preferred access. Apple no longer has leverage to demand favorable pricing. Suppliers now have the leverage, and suppliers are raising prices. Let me explain what this means. Apple just reported that it's facing constraints due to availability of advanced chips that power Apple's devices. Constraints. That word wouldn't have been in Apple's vocabulary 2 years ago. Apple controls so much of the market, Apple was always able to get what it needed. Now, Apple is constrained. Memory prices are increasing significantly. Semiconductor costs are rising. The components that make iPhones faster and more capable are becoming more expensive, and Apple can't easily pass those costs to customers without losing volume. Here's the financial reality. Apple reported record quarterly revenue of nearly $144 billion, record net income of $42.1 billion. But that record profit came despite rising input costs and component constraints. Without those constraints, Apple's profit would be even higher. Going forward, the constraint gets worse. Later this year, suppliers will push through more price increases. Apple will face even more margin pressure. And the market knows it. Analysts are already modeling margin compression. Supply chain analysts like Ming-Chi Kuo are explicitly saying Apple won't raise iPhone prices for next year's iPhone 18 lineup. Instead, Apple will absorb the cost increases and accept lower gross profit margins. That's the admission. Apple is willing to take lower margins to protect volume. That's a strategic choice. And it's a defensive choice. Now let me explain how Apple is responding. And this is where the capital allocation thinking becomes clear. Apple can't raise iPhone prices without significant volume loss. Competitors exist. Customers have alternatives. China is competitive. If Apple raises prices too aggressively, customers will defect. So pricing power is limited. What can Apple do? Apple can manage mix. Apple can shift the customer base toward higher margin products. Apple can encourage customers to buy the more expensive versions. This is exactly what's happening. Look at the iPhone product line. There's the base iPhone 17. There's the iPhone 17 Pro. There's the iPhone 17 Pro Max. And now there's the iPhone Air. The base iPhone 17 costs less. The Pro and Pro Max cost more. The Air is supposed to be a premium thin and light product positioned between base and Pro. The data shows what's working and what's not. Pro and Pro Max models now represent 52% of iPhone sales in the US. In the December quarter, a year ago they were 39%. That's a 13-point shift toward premium in a single year. That's the capital allocation strategy in action. Apple is not raising prices. Apple is shifting the mix of what customers buy. Apple is making premium models more attractive. Apple is getting customers to upgrade to higher margin products. The iPhone Air was supposed to help with this. It's a thin and light design. Critics loved it. Apple positioned it as a premium option between base and Pro. But customers didn't bite. The Air costs $200 more than the base iPhone 17. But the base iPhone 17 has a better camera and better battery. Customers looked at that trade-off and said, the Air doesn't make sense. I'll buy the base model, or I'll jump to Pro. The Air is too expensive for what it offers. That's a market rejection. That's consumers telling Apple, your positioning is wrong. You can't create a premium tier without a compelling value proposition. But the Pro and Pro Max success shows that customers will pay for legitimate upgrades, more capable processors, better cameras, better displays, longer battery life. Customers understand the value and will pay. So Apple's strategy is clear. Abandon the middle ground. Make the base iPhone cheap and capable. Make the Pro and Pro Max genuinely better. Encourage the mix shift toward Pro and Pro Max. Accept that some customers won't upgrade, but make sure the ones who do upgrade to the highest margin models. This is working. 52% of sales in premium models is a massive shift. That's billions in additional revenue at higher margins. Now let me talk about the other capital allocation moves Apple is making. Apple acquired an Israeli startup called Q.ai. The technology is whisper speech, the ability to communicate quietly or non-verbally with future devices, like smart glasses. This is not a consumer-facing product. This is a technology bet on future interfaces. Why is this acquisition important? Because it shows Apple is thinking beyond iPhone. Apple is preparing for a world where smart glasses and wearables are the primary interface. And Apple is acquiring specific capabilities to make that future product better. That's capital allocation thinking. Not buying revenues today, buying technology and talent for the future. Apple also announced a partnership with Google. Google's Gemini will power a more personalized Siri. Siri is Apple's AI assistant. It's been frankly mediocre compared to ChatGPT and other AI assistants. Competitors have better AI. Apple's Siri lags. So Apple partnered with Google to use Google's superior AI technology. This is a pragmatic move. Apple could have spent years building better AI internally. Instead, Apple leveraged Google's technology and focused on the partnership. This is capital allocation too. Spend money to improve the product experience rather than building internal capabilities that would take years. Now let me explain the tariff situation. Apple benefited significantly from Trump administration tariff policy. The Trump administration halved the tariff on Chinese imports in November. Apple had expected tariff costs of $1.4 billion in the December quarter. That tariff reduction saves Apple hundreds of millions in this quarter and going forward. This is important to understand. Apple's margin expansion in this quarter was helped by an external policy change. The tariff reduction is temporary. If tariff policy changes, that benefit disappears. Apple is capitalizing on a policy window. That's smart, but it's also temporary. Now let me do the capital allocation autopsy of Apple's position. What was expected? Analysts expected strong iPhone demand. iPhone 17 is new. New iPhones drive upgrade cycles. Analysts expected record revenue and strong profit growth. What's actually happening? Apple is hitting those expectations. But underneath, there are structural pressures. Component costs are rising. Supplier leverage is increasing. Margin pressure is real. Apple's response is to manage mix and absorb some costs while leveraging temporary tariff benefits. The opportunity cost? If Apple raises prices too aggressively, it loses volume and ecosystem position. If Apple doesn't manage costs aggressively, margins compress. Apple is trying to navigate the middle, protect margin through mix, leverage tariff benefits, absorb some cost increases, and maintain volume through competitive pricing. The hidden trade-off? The product mix strategy only works if customers perceive value in premium models. The iPhone Air showed that customers won't pay for thinness alone. Apple's strategy depends on making Pro and Pro Max genuinely more capable than base models. That requires investment. That requires ongoing R&D. That requires constant feature differentiation. If competitors copy those features quickly, the premium positioning erodes. If customers feel that the base model is good enough, the mix shift stops. Apple's strategy only works if premium is always better in ways customers value. Now let me extract 3 lessons from Apple's financial reality. First, pricing power is structural, not permanent. Apple built an extraordinary business through relentless focus on customer value and ecosystem lock-in. That created pricing power. But pricing power is dependent on the broader competitive and supply chain environment. When that environment changes, when suppliers shift focus to AI customers, pricing power erodes. Apple didn't suddenly become less good at making iPhones, but Apple's leverage over suppliers changed, and that required a strategic shift from pricing power to mix management. The lesson is simple. Your competitive advantages are not permanent. They depend on the environment. When the environment changes, your strategy must change. Second, capital allocation in maturity means managing constraints, not chasing growth. Apple is still growing. Apple is still profitable. But Apple is no longer in a growth without constraints phase. Suppliers are constraining capacity. Customers are constraining willingness to pay high prices. Competitors are constraining competitive advantage. Apple's capital allocation is now about managing these constraints. Mix shift, cost management, strategic M&A for capabilities, tariff arbitrage. These are not growth strategies. These are maturity strategies. The lesson is simple. Growth companies think about expansion. Mature companies think about constraint management. Third, mix shift is powerful but fragile. Apple's shift toward premium models is working. 52% of sales in premium models is a massive achievement, but it's also fragile. One failed product like iPhone Air shows that customers won't always follow where Apple leads. One competitive product that matches Apple's premium features undermines the premium positioning. One economic downturn that reduces consumer spending hits premium harder than base. Mix shift is a brilliant capital allocation move, but it requires constant execution and customer perception management. Here's my closing conviction. Apple is at an inflection point. The company is not in crisis. The company is still enormously profitable. The company is still growing. But the era of simple margin expansion through price increases is ending. The era of supplier leverage and preferred access is ending. The era where Apple could raise prices and customers would simply accept it. That's over. Now Apple must manage mix. Now Apple must manage costs. Now Apple must manage suppliers and navigate the reality that AI demand is reshaping the entire supply chain. Apple will succeed at this. Cook is a brilliant operator. Apple has the resources to invest in new capabilities and new products, but the game has changed. And change in Apple's fundamental business model always takes time to play out. The shareholders who think Apple is still in the simple growth phase, those shareholders are missing the inflection. Apple's record profits are real, but they're hiding structural margin pressure. That margin pressure is only going to get worse before it gets better. Here's the sentence you'll remember. Record profits can hide structural margin compression when the company is transitioning from pricing power to mix management. Moving to next title, Hyundai flags risks as profit slumps. Hyundai Motor just reported annual profit down 22%, but revenue up 6.3%. Think about that for a moment. Sales growing, market share holding, product execution improving, and profit collapsing. This is not a story about business execution. This is a story about what happens when government policy destroys the profit equation independent of management quality. This is a story about a good operator trapped in a terrible business environment, and what that company does in response. From the Wall Street Journal, Hyundai Motor is South Korea's largest automaker. It's been a serious global competitor for decades. Not the sexiest brand, but competent, professional, well-managed. The company competes in nearly every market globally, and it's been expanding despite challenges, until tariffs happened. Hyundai's CEO is Andrew Silvernail. Silvernail has been in the role and driving operational improvements. The company has been modernizing supply chains, improving efficiency, launching new products. The fundamentals look good from an operations perspective, but none of that matters when tariff policy becomes the primary driver of profit. Here's what happened. Trump administration imposed tariffs. Initial rate was 15% starting in November. That rate applies to Korean cars entering the United States. Hyundai is one of Korea's largest car exporters to America, so the tariff hits directly. But wait, there's more. Trump threatened 25% tariffs unless Korea approves the trade deal. Korea's legislature hasn't approved the deal yet. So Hyundai is facing existential tariff risk. 25% tariffs would destroy profitability entirely. Let me explain the numbers so you understand the scale. Hyundai calculated that Trump's tariffs cost the company an estimated $2.87 billion last year. $2.87 billion. That's nearly the company's entire annual net profit. And Hyundai is projecting a similar $2.87 billion tariff hit in 2026. Think about that. The company is expecting to lose as much profit to tariffs as it actually makes. Now look at the quarterly results. Fourth quarter net profit slumped 52%. 52% in a single quarter. And this is despite sales growing, despite market conditions stabilizing, despite the 15% tariff rate being lower than the threatened 25%. The company reported sales surged 6.3% for the full year. Revenue is growing. Market demand is there. But operating profit fell 19%. Fourth quarter operating profit fell 40%. Revenue up, profit down. That's the tariff trap. You can grow sales all day. But if tariff policy is eating your margin, you can't grow earnings. Now here's the critical part. Hyundai didn't benefit from the reduced tariff rate starting in November. Why? Because the company had already accumulated massive inventory during the higher tariff period. Inventory built up, then tariffs dropped to 15%. But Hyundai had to clear the accumulated inventory first, so the company is stuck with legacy inventory at higher tariff costs while selling new inventory at lower tariff costs. That's a margin squeeze both directions. This is a glimpse into what tariff policy actually does. It destroys incentives, it creates distortions, it forces companies into bad inventory decisions, and it grinds margins lower. Now let me explain the bigger picture. Hyundai is facing secular challenges independent of tariffs. The automotive industry is slowing. Global demand is softening. Chinese competition is intensifying. Hyundai described 2025 as a challenging year marked by slowing global demand and intensifying competition as Chinese car makers expanded overseas. Chinese competition is the real story here. Tesla dominates the premium electric vehicle segment. Chinese EV makers dominate the mid-market and emerging markets. Hyundai is caught in between. Higher costs than Chinese competitors, but not premium enough to compete with Tesla. Hyundai's margins are being squeezed from above and below. Wholesale volumes tell the story. Global wholesale car sales edged down 0.1%, essentially flat. Hyundai sold 4.14 million units. That's flat to down. In a growing global population, with more people moving to middle class and more demand for vehicles, Hyundai's volumes are flat. That tells you everything. If you're not growing volume in a growing market, you're losing share. That's the competitive pressure from China. Now look at Hyundai's guidance for 2026. The company is targeting 4.16 million vehicles. That's essentially flat. Growth of 0.05%. And revenue growth guidance is only 1 to 2%. That's flat growth guidance for a global automaker. In a growing world economy, flat growth guidance. That's admission of weakness. That's management saying, we don't expect to grow in 2026. Why? Because global conditions will remain tough, competition will intensify, and tariff uncertainty continues to hang over everything. Here's the capital allocation problem Hyundai faces. The company needs to invest. It needs to invest in new platforms, electric vehicles, hybrid vehicles, advanced driver assistance systems, software-defined vehicle architecture. All of this requires capital. Hyundai is planning to invest 17.8 trillion won this year. That's roughly $13 billion. That's a huge capital commitment in an environment where profits are collapsing. Think about the incentive problem. Every dollar spent on future products is a dollar of margin compressed today. The company is being squeezed by tariffs. The company is being squeezed by competition. And management is saying, we need to invest heavily in the future anyway. That's the trap. You can't cut CapEx because the competition won't wait. You can't raise prices because customers will defect. You can't reduce costs fast enough because tariffs keep changing the rules. So you're forced to invest while profits collapse. This is why Hyundai did something brilliant. The company invested in Boston Dynamics. Let me explain this play. Boston Dynamics is an American robotics company. It develops humanoid robots. The most famous is Atlas. Atlas is the humanoid robot that can walk, climb stairs, handle objects. It's the closest thing to science fiction robots we have in reality. Hyundai owns 27.1% of Boston Dynamics through an investment called HMG Global. This is a relatively small stake, but it gives Hyundai exposure to the robotics business. Here's Hyundai's strategic bet. The company plans to deploy humanoid robots at manufacturing plants starting in 2200, not as a research project, as actual production equipment. The company wants to produce 30,000 Atlas units globally each year. 30,000. That's not an experiment. That's a business. Why is this a capital allocation masterstroke? Because it creates a profit center outside of automotive. Robotics is not subject to automotive tariffs. Robotics has different margins. Robotics has different competitive dynamics. Hyundai is building a new business that's insulated from the tariff trap. And the financial thesis is compelling. Analysts at KB Securities estimate that Boston Dynamics will be valued at 128 trillion won by 2035. 128 trillion won. That's roughly $100 billion at current exchange rates. Hyundai's 27.1% stake would be worth roughly 35 trillion won. That's roughly $26 billion. Now think about what that means for Hyundai's valuation. Current annual profit is roughly 10 trillion won. Current profit multiple is probably 8 to 10 times. So Hyundai is worth roughly 80 to 100 trillion won today. 80 to 100. If Boston Dynamics creates a 35 trillion won stake, that's a 40 to 50% increase in enterprise value from a single investment. And that's not even assuming Boston Dynamics becomes a massive, profitable business. That's just the valuation of the company. If Boston Dynamics actually achieves profitability, Hyundai's value could be multiples higher. This is why Nomura analysts said something fascinating. They said investors should shift their focus to longer-term value drivers for Hyundai, such as robotics, software-defined vehicles, and advanced driver assistance systems. Translation: the automotive business is challenged. Don't focus on that. Focus on the robotics bet. That's where value is being created. Now here's the uncomfortable truth. Hyundai is admitting that its core business, making and selling cars, is no longer where money is being made. The margins are compressed. The competition is brutal. Government policy is unpredictable. So Hyundai is pivoting. The company is investing in robotics. The company is investing in software. The company is preparing for a future where humanoid robots do manufacturing work instead of people. This is a company admitting, automotive margins are broken. I need new profit centers. Now let me do the capital allocation autopsy. What was expected? Hyundai was expected to report declining earnings but remain profitable. Analysts expected a net loss of roughly 36 cents per share. Wait, did I say loss? Let me check the data. Yes, analysts expected a loss for the quarter, but Hyundai beat that expectation. What actually happened? Hyundai reported better than expected adjusted earnings. Stripping out one-time charges, the company earned about 70 cents per share. That beat expectations of 65 cents per share. But the underlying story is grim. The company's operating profit collapsed. The company's net margins compressed. The company is growing sales while shrinking profit. The opportunity cost? Hyundai had choices. The company could have cut CapEx to protect current earnings. That would have boosted short-term profit. But it would have left the company uncompetitive long-term. The company could have raised prices to offset tariffs. That would have boosted margins, but it would have lost market share to Chinese competitors. Hyundai chose to invest in the future while current margins compress. That's the smart choice. But it's a capital allocation choice that hurts today to save tomorrow. The hidden trade-off? Hyundai is betting that Boston Dynamics becomes valuable faster than automotive margins decline further. If Boston Dynamics' valuation accelerates, if humanoid robots become essential manufacturing equipment, if the robotics business becomes globally adopted, then the bet pays off huge. But if robotics adoption is slower than expected, if the technology doesn't translate to manufacturing, if competitors develop better robots, then Hyundai is investing heavily in a future that never arrives while the present collapses. Now let me extract 3 timeless lessons from Hyundai's situation. First, external constraints destroy business quality independent of management excellence. Hyundai is well managed. The company is executing better. But tariff policy is beyond management's control. The company can improve operations all day. But if tariff policy crushes margins, operational excellence is irrelevant. The lesson is simple. Business quality is partly about management, but it's also about the external environment. And when external constraints become binding, even great managers struggle. This is why competitive advantages matter. Companies without tariff exposure, Tesla, some Chinese makers, are winning. Companies with tariff exposure, Hyundai, are losing. It's not because Hyundai is poorly managed. It's because the external environment has changed. Second, revenue growth and profit growth can diverge sharply when costs are externally imposed. Hyundai grew sales 6.3%, but profit fell 22%. Revenue and profit decoupled. Why? Because tariffs are a cost imposed by government policy, not by business decisions. Hyundai can't control tariff costs the way it controls manufacturing costs. When external costs increase faster than revenue, profit margins compress. The lesson is simple. Watch for situations where revenue is growing but profit is declining. That's usually a sign that costs are being imposed externally and the company can't pass them through pricing. Third, capital allocation under margin pressure requires investing in entirely new businesses, not just optimizing existing ones. Hyundai can't solve its problem through automotive efficiency. The company needs new profit centers. That's why Boston Dynamics matters. That's why robotics investment matters. When your core business is being crushed by external factors, you can't innovate your way out. You need new businesses. That requires capital discipline. That requires betting on technologies that might not work. That's the ultimate capital allocation challenge. Here's my closing conviction. Hyundai is a well-managed company trapped in a terrible situation. The company's fundamentals are decent. The company's execution is solid. But tariff policy has made automotive profitability fragile. The Boston Dynamics bet is smart. It's the right strategic response. But it's also an admission that the core business is challenged. Hyundai is building a new future because the present is unsustainable. Will it work? Maybe. If humanoid robots become essential. If Hyundai's stake grows dramatically in value. If the robotics business generates returns that compound over decades, then Hyundai's Boston Dynamics investment could transform the company's long-term value. But that's a long bet. And it's a bet against tariff policy, Chinese competition, and automotive margin collapse all happening simultaneously. The investors who see value in Hyundai are betting on the robotics future. The investors who see risk are betting on tariff escalation and automotive margin compression. Both could be right. Here's the sentence you'll remember. When external policy destroys your core business profitability, building new businesses is not optional. It's existential. Now towards last article, Meta overshadows Microsoft with AI payoff. Two companies, two huge AI bets. Same trillion-dollar market opportunity. Different results. Meta and Microsoft are the two biggest AI spenders in tech right now. They're racing each other to build artificial intelligence capabilities. Both companies have moved from cautious investment to all-in commitment. Both are sacrificing short-term profits for long-term dominance. But their earnings reports last week told completely different stories. Meta came out and said, "Our revenue is accelerating to 30% growth. AI is working. We're doubling down. We're spending $125 billion this year on AI infrastructure." Microsoft came out and said, "Our cloud business growth is slowing. We're still allocating resources. We're constrained by limited AI computing. We'll figure this out." One company showed that AI spending generates immediate returns. The other showed that AI spending is still a bet on the future. From the Wall Street Journal. Let me explain what's really happening here. Mark Zuckerberg runs Meta. He runs Facebook and Instagram. These are advertising businesses. The entire company exists to show you ads and get you to click on them. That's it. That's the whole business model. 98% of Meta's revenue comes from advertising, nothing else. Zuckerberg has decided to bet everything on AI. Why? Because AI recommendation systems can get people to click on more ads. Better recommendations mean more engagement. More engagement means higher advertising rates. Higher rates mean more revenue. That's the simple equation. Zuckerberg has explicitly credited AI with helping boost user engagement and ad performance. He said on the earnings call something remarkable. He said, "Our world-class recommendation systems are already driving meaningful growth across our apps and ads business, but we think that the current systems are primitive compared to what will be possible soon." Let me translate that for you. Zuckerberg is saying, we're already seeing results from AI. We're already making more money from AI recommendations. But this is just the beginning. The best is yet to come. That's a CEO with conviction. That's a CEO who has already validated the AI bet in his core business. Now let me contrast that with Microsoft. Satya Nadella runs Microsoft. Microsoft makes cloud computing, enterprise software, productivity tools, gaming, consumer devices. It's complex. It's messy. It's multiple stakeholders competing for resources. Azure is Microsoft's cloud business. Azure is where AI is supposed to generate returns. But the results are mixed. Azure grew 39% in the latest quarter. That sounds good, but the previous quarter was 40%. So growth is slowing. That's not what you want to hear from a CEO who's spending billions on AI. And here's the critical part. Amy Hood, Microsoft's CFO, said something really revealing. She said, if the company had allocated all of its latest GPU chips to Azure, the growth rate would have been above 40 in the latest quarter. Think about what that means. Microsoft has limited GPU chips, limited AI computing capacity. The company has to choose. Use the chips for Azure customers, or use the chips for Microsoft's own internal AI development. Microsoft chose to use chips for internal development. Azure customers got fewer chips, so Azure growth slowed because Microsoft is starving the external business to feed internal development. That's not a choice you want to admit making. But Hood did, and it reveals something fundamental about Microsoft's strategy. The company is no longer optimizing for Azure growth. The company is optimizing for internal AI capability development, even if it means losing market share in its main cloud business. Now let me show you what's visible on screen. There's a chart showing capital spending per calendar year for both companies. What you're looking at is a line graph. Two lines. One is Meta, one is Microsoft. The graph runs from 2015 through 2026. The vertical axis is capital spending in billions of dollars. The horizontal axis is years. What you see is this. Both lines were relatively flat and low from 2015 through 2022. Both companies spent maybe $20 to $40 billion a year. Then starting in 2023, both lines go vertical. Meta goes from maybe $30 billion to $70, $80, $90 billion. Microsoft goes from maybe $40 billion to $100 billion or more. And 22.6 guidance, shown as the midpoint of company guidance, has Meta hitting roughly $125 billion, maybe higher. This is not incremental spending. This is a complete structural shift. Both companies have decided to spend at least double what they spent historically. The question is, are they getting returns? Meta says yes. Meta reported guidance for Q1 2026 of 30% revenue growth. The midpoint is $55 billion in revenue. That would be Meta's fastest growth since the company was recovering from its COVID boost back in 2021. 30% revenue growth. At Meta's scale, that's extraordinary. Analysts say that beats Wall Street projections. And Zuckerberg explicitly credited AI with driving this acceleration. Microsoft says, maybe, Azure grew 39%. But it should have grown 40% or higher if Microsoft wasn't allocating chips internally. And guidance implies growth is slowing. Not accelerating, slowing. This matters. Here's what Dan Salmon of New Street Research wrote. Jaw-dropping revenue acceleration trumps heavy investment, easily. He's saying, when you can show that spending is generating results, investors forgive big capex. Meta showed results. Now investors forgive Meta's $125 billion spending plan. Now look at the second chart on screen. This shows stock performance over the past 6 months. The graph shows 5 lines. Alphabet, Amazon, Nasdaq Composite, Meta, Microsoft. What you see is this. Alphabet, Amazon, and the overall Nasdaq Composite are all UP. They're up significantly, 20s, 30s, 40% range. But Meta and Microsoft are down. They're in negative territory. They've lost ground over the past 6 months. Why? Because investors have been worried about runaway AI spending. Worried that both Meta and Microsoft are throwing massive money at AI without clear returns. But here's what changed last week. Meta's earnings came out. Meta showed acceleration. Revenue growth 30%. AI working. Company showed returns on the spending. What happened to Meta's stock? It went up. First time in 6 months. Microsoft's earnings came out. Microsoft showed deceleration. Azure growth slowing. No clear returns yet. Spending is a bet. What happened to Microsoft's stock? It went down. Further down. This is the market differentiating. This is investors saying, we forgive spending when we see returns. Meta is showing returns. Microsoft is showing hopes. Now let me explain the fundamental difference between these two companies' AI strategies. Meta's AI spending goes directly to one place, making ads more effective, better recommendations, more user engagement, higher advertising rates. That's the entire chain. Spend on AI better, ad targeting, more engagement, higher revenue, proof that AI works. Microsoft's AI spending goes to multiple places. Some goes to Azure to serve customer needs. Some goes to internal development of Copilot and other products. Some goes to maintaining existing businesses like Office and Windows. Some goes to gaming and consumer devices. When you have multiple allocation decisions with limited resources, you always face trade-offs. Amy Hood's comment about GPU allocation proves that. Microsoft is choosing internal AI development over serving external Azure customers at the highest possible growth rate. Is that the right choice? Maybe. Building internal AI capabilities could create long-term advantage, but short-term, it means Azure growth slows. This is the essence of the capital allocation problem. Meta has one thing to optimize for: advertising effectiveness through AI. Microsoft has 5 or more things to optimize for: cloud, enterprise software, consumer, gaming, and internal AI development. When you're optimizing for multiple things with limited resources, you always underperform in each thing compared to a company optimizing for one thing. That's why Meta is showing 30% growth and Microsoft is showing 39% growth. That's decelerating. Now let me talk about the capital spending plans. This is where it gets really interesting. Meta is planning to spend between $115 billion and $135 billion in 2026. The midpoint is roughly $125 billion. That's roughly half of Meta's projected annual revenue. Think about that. Half of revenue going to capital expenditure. In historical terms, Meta spent less than a quarter of revenue on CapEx. So Meta is more than doubling its capital intensity. Why would a company do that? Because it believes the returns on that spending are so high that sacrificing current profits is worth it. Meta is betting that by investing in AI infrastructure now, the company will own the future of AI-driven advertising. That's a bold bet. That's an all-in commitment. That's conviction. Now, Meta's business is actually quite profitable. The company has huge margins. Advertising is a high-margin business. So Meta can afford to double CapEx while still earning good profits. But profits will be lower than they otherwise would be. The question is, will AI-driven revenue growth justify the lower near-term profits? Meta is betting yes. The company is betting that 30% growth for multiple years justifies $125 billion in annual spending. Microsoft is in a different position. Microsoft's businesses are more fragmented. Azure is growing 39%, but that's slower than expected given AI. Xbox is declining. Enterprise software is mature. The company is spending massive amounts on AI, but getting mixed returns across different business units. This is the fundamental tension. Meta's simple business model makes capital allocation easier. Microsoft's complex business model makes capital allocation harder. Now, let me talk about the constraint that affects both companies. Both Meta and Microsoft say they're constrained by limited AI computing resources. GPU chips are in short supply. Memory is in short supply. Foundry capacity is limited. For Meta, this is annoying but not terrible. Meta wants more chips. But Meta's AI spending is making the core business more profitable. So even if constrained, the returns justify the spending. For Microsoft, this constraint is more problematic. Microsoft has to choose who gets the GPUs: internal development or external customers. CFO Amy Hood's comment reveals that Microsoft is choosing internal development. That slows Azure growth. That creates competitive risk if companies like Google or Amazon are serving cloud AI customers faster. The constraint affects them differently because of business model difference. Meta's constraint doesn't hurt the core business because the core business is benefiting from AI. Microsoft's constraint hurts the core business because it's being starved for resources to feed internal development. Now let me extract 3 timeless lessons from this Meta versus Microsoft story. First, business model simplicity enables faster capital allocation decision-making. Meta has one business: advertising. All decisions flow from that. When an opportunity improves advertising, Meta says yes. When it doesn't, Meta says no. Microsoft has multiple businesses, each demanding capital, each demanding resources, each demanding management attention. When you're juggling multiple priorities with limited resources, you always sacrifice something. Meta doesn't have that problem. This is why Buffett loves simple businesses. Simple businesses are easier to run, they're easier to allocate capital for, and they're easier to explain to investors. Second, spending shows returns faster in core business than in future business. Meta's AI spending is improving its existing core advertising business right now. Revenue accelerating, returns visible today. This makes it easy to justify more spending. Microsoft's AI spending is building future cloud capabilities and internal AI tools. Returns uncertain, growth decelerating. This makes it harder to justify spending. The lesson is simple. Investors are more forgiving of spending when returns are visible today rather than tomorrow. This is not to say future investments are bad. It's just to say that validation matters. Third, constraints reveal strategic priorities. Amy Hood revealing that Microsoft is allocating chips to internal development rather than external customers is revealing where Microsoft's true priorities are. The company values internal AI capability building over Azure customer growth. That's a strategic statement. Maybe the right one, but it's a statement nonetheless. When resources are limited, how you allocate them shows your true priorities, and the market pays attention to those priorities. Here's my closing conviction. Meta and Microsoft are in very different positions. Meta is a simple advertising business using AI to improve that business right now. Returns are visible. Revenue is accelerating. Investors are forgiving high capex because they can see the benefit. Microsoft is a complex, multi-unit business using AI to build future capabilities. Returns are uncertain. Growth is decelerating. Investors are worried because returns aren't visible yet. The winner of this race won't necessarily be the company that spends the most. The winner will be the company that gets the clearest return on that spending soonest. Right now, Meta is winning. Not because Meta's AI is better, but because Meta's business model makes it easier to show that AI is working. Here's the sentence you'll remember. Simple businesses get forgiveness for big spending. Complex businesses have to prove the spending works. This is Avi. Like and subscribe. On to the next.